You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have British American Tobacco, Dunelm, Unilever, Barratt Developments, Redrow, and our US company of the week is Disney. Sam, shall I start with British American Tobacco?
Yeah, let's start with BAT.
BAT. So it's the UK's largest tobacco company, and they had their full year results out this week, with full year revenue up 6.9% to £25.7 billion, ignoring the effect of exchange rates. And it's also worth mentioning that that includes an increase of nearly 51% in revenue from new categories to £2 billion, which includes the reduced harm products like Vuse and Vuse e-cigarettes. The group is also expecting to raise that to £5 billion and for the division to become profitable by 2025 as stick volumes in the combustibles division continue to fall. In the combustible division, revenue overall increased, which was driven almost entirely by price rises, with volumes falling 7%. In the US, revenue was up 9.2% to £12.5 billion, with a 53.3% increase in new categories, the vaping products we've just mentioned, and combustible revenue increased to £10.7 billion, which represented an 8.1% increase, again driven by price rises. Cigarette volumes were down 5% to 70 billion sticks. Operating profits for the US division were up 9.7%, coming in at £6.3 billion. In Asia Pacific and the Middle East, the group saw oral tobacco, which includes snus and snuff, nearly triple. In new categories, revenue grew 14.2% and totaled £588 million. Total combustible revenue was down 2.3% to £3.8 billion due to a less profitable mix of geographic sales and price competition in Australasia. Operating profit for the division came in at £1.8 billion, which is 1.1% lower than the previous year. In the Americas and Sub-Saharan Africa, revenue was up 7.8% to £4.1 billion, with growth in combustibles and new categories. Operating profits rose 4.3% to £1.7 billion. In Europe and North America, revenues rose 7.3% to £6.4 billion, but operating profits were down 1% with the ongoing investment in the new categories. In terms of valuation, British American Tobacco has a market capitalisation of £78.5 billion and trades at 9.1 times forward earnings, with a prospective dividend yield of 7.1%. The group also announced a £2 billion share buyback alongside these results. In terms of my view, there are clearly ethical concerns with any tobacco company, but if we put these aside and look at British American Tobacco from a purely business point of view, it looks like a very stable business, especially in the uncertain times that we are living in. And even if it's an industry in structural decline, it's putting out numbers like this. I think the sales growth in the new categories is particularly impressive and may well be the future of the business. And it's worth noting that it is a market leader in the US and in the UK, which is a real achievement for the business. And I think also when you compare it with with its competitors like Imperial Brands, it's far more global, which again makes it less vulnerable to the sharper declines of smoking in Western countries like the UK. That being said, there are still ongoing regulatory concerns, and the idea of reducing or having nicotine limits would be something that could hit any tobacco company, and British America, if it's in the US because of its large exposure to the US market after acquiring Reynolds Tobacco, and same with the banning of menthol, which has been proposed in the US. On balance, though, I think it looks cheap at just 9 times forward earnings, and when it's paying a dividend of 7.1%, some might consider that a risk worth taking. Sam, what are your thoughts?
I agree. I think it's very impressive. On the traditional side, you sort of know what to expect. I don't think we've ever looked at the traditional side of the business, never been surprised by it. I do think the 53% increase in or the 50% increase or whatever it is in new categories is very, very impressive. think it's very impressive. It's the market leader, and it does look like it has a future. And if you compare it as well, I mean, last time we looked at Imperial Brands, their new categories are just not doing as well. They're pulling out of markets, and the execution by British American, it just seems to be much, much better. I think new categories isn't really priced in at all, because it is priced as if it's a business which is just in permanent decline, which it may well be. But I mean, with the amount of cash you're going to get out of this business over the next, I don't know, 10, 15 years, if it's then a decent sized business at the end with new categories, I think I think it's hard to buy the shares and not do well if that happens. It may not happen, but if you think it will happen, I think it would be difficult to buy the shares and not do well at these prices. The only other thing is when they first started talking about limiting the amount of nicotine in the cigarettes, I think we talked about it on the show. We both came to the conclusion, well, that'd be a disaster. I listened to another podcast, I think it was Value After Hours, like the week after, and they were saying, well, could it be a good thing? Because if there's less nicotine, you're going to smoke more of them. Does it really? Do you know what I mean? You might just
smoke two together.
Yeah, well, yeah, just put an elastic band around them or something. So it'd be interesting to see what the impact is, but it might not be as bad as first thought.
A bit like the advertising, when advertising was banned, they still sold or even grew stick volume, but they had less that they had to spend on advertising and marketing. Yeah, so it's just very, very cheap. It's a very, very good business. I mean, like you say, if you take aside the fact that it's tobacco, I mean, if you was to present it as a case study to most investors and sort of doctor it so they didn't know it was a tobacco company, I think a lot of people would be very, very interested in it at these prices. Yeah. And I suppose one of the things that perhaps has depressed the share prices for the tobacco companies is the move to ESG, and that funds have been selling out of them. Yeah. Well, I think you should buy it not expecting a revaluation in the multiple. Yeah. Although that has happened somewhat, it is slightly more expensive than it was. But I think you should just buy it based on the amount of cash you think you're going to get out of it. You shouldn't buy it if you think in a year's time it's going to be at 20 times earnings instead of 9. Yeah. I mean, when it peaked, I think it was back sort of 2016, 2017, it was about 50 pounds a share or so, but it was trading at maybe 17, 18 times earnings back then. Yeah, so I don't know. It depends I can't see it market though, because because that was just after Brexit, wasn't it? When it was like people looking for safe havens, and if you got a similar circumstance, maybe people would pay more for it. But have you finished reading Down Tobacco Road? I haven't, but I have been enjoying what I've read of it, and that is about Reynolds Tobacco mainly, but it does have Buck Duke in it too. So there is sort of overlap with British American, and I suppose, overlap with British American also from the Reynolds side, which they acquired a few years ago. But it is very interesting, and I think there probably are a lot of general business lessons to learn from it. Yeah, it's interesting as well. I do wonder, like, when you look at like what they were doing, where they were buying other businesses and trying to like create their own future after tobacco, which when you think they were doing that in the 70s and 80s seems a bit looking too far into the future now, because here we are 40, 50 years later and they're still doing fine. Yeah. If you look at that, I do wonder if there's any comparisons to be made with like Facebook, with like their VR stuff and Oculus. Like, would they be better just saying, well, they're getting so much cash out of Facebook, just keep growing that and returning it? Because it's like, if you look at the Facebook earnings and you strip out the amount they're investing into Oculus, it's trading. I think I saw a stat the other day where it's like trading at like 13 times earnings, but the earnings are depressed because of everything they're putting into Oculus. Yeah, I see what you mean. Just interesting. I don't know enough about Oculus. I definitely don't think that's the case with British American and their sort of, I suppose, the new categories. Well, new categories makes more sense. Whereas if they were to say, I mean, I guess the modern day equivalent would be if they were to say, well, we're gonna buy Unilever or I know it's a bit too big for them to swallow, but if they say, well, we're gonna buy Unilever or like a Reckitt or something like that. The health division of Glaxo. Yeah, something like that. That's more what they were doing in the 70s and 80s. Yeah. Which in fairness is probably like, again, still quite different from Facebook and Oculus. But I mean, you could look at, Philip Morris over in the US with Vectura. That's probably closer, I'd say. Yeah. Wow. The pharmaceutical, but anyway, that's not what British American are doing. So, and what do you think of the share buyback, £2 billion? I'd probably, if I was a shareholder, I'd probably rather it was returned as a dividend. But that's just because it's like we've had the conversation. Like if you were say you're normally reinvesting dividends,
would you reinvest your tobacco dividends? And my view is you shouldn't, because you sort of, if it's in terminal decline, you want to get the cash out of it. You don't want to own a larger share of a business that's shrinking. I'd rather get the cash out and invest it somewhere else and just keep getting the cash until there's no more cash for you.
Yeah. No, I would agree with you on that. I'd agree with you on that.
Should we move on to Dunelm then?
Dunelm.
Yes. So Dunelm, the home of homes, for anyone who doesn't know them, they have come out with their half-year results. Some of the highlights were 2 year-over-year digital sales growth. So digital sales growth compared to 2 years ago was 121%. Active customer growth was 6.3%. Gross margin increase of 80 basis points. Profit before tax grew 25.3%. Operating costs as a proportion of sales fell from 35.5% to 34.8%. Free cash flow increased from 98 million to 106.3 million. Diluted earnings per share increased by 25.6% to 55.4p a share. Total sales grew by 10% year over year to 795.6 million and 36% over 2 years. And digital sales as a percentage of total sales is 33% now. That's down 2% from a year ago, but still up 13% from 2 years ago. And the digital sales are now 263 million out of the total of 795.6. Cash generation was strong with the free cash flow to operating profit ratio of 74%, and that's down from 83% a year ago. However, that's mainly due to working capital outflow due to their decision to build inventory levels to mitigate against supply chain disruption, which if I was a shareholder, I would not have an issue with at all.
Mm-hmm.
Let's see what else. Oh, market share gains. They said in the last 5 calendar years to 2021, 85% of their growth has come from market share gains rather than increasing the size of the market. The long-term sales compound annual growth rate is 10%. And over 10 years, the market's grown at a rate of 1.4% and they've grown at 10%. At 5 years, they're 10% versus 1.5% for the market. And over 2 years, they're 12% versus 2.2% for the market. They've got 13 million active customers now, and that's up 3 million from 2016. And the digital sales have grown 5x in 5 years. And they've said that's fed through into a 30% increase in average store sales as well. Just because 37% of the customers now shop online or through multi-channel, and the multi-channel customers shop 5 times as often and spend 6 times as much. In terms of the valuation, when you factor in these results, it's now trading at a P of 17. And over the last 5 years prior to this year, which is up about 20, it's up about a quarter or whatever it was, the revenue is up 40% in the past 5 years and 47%, and the earnings per share is up 47%. My view is I think these are excellent results. I mean, the only negative for me was probably that online sales as a proportion of total decreased slightly, but it is only a slight decrease and it is against very tough comparatives. So I could probably forgive them for that. And I think the rest of it is fantastic, actually. I think it's a very good business. I think a P of 17, it's probably pretty fair, actually, because I think the 40% revenue growth and 47% earnings per share growth in the last 5 years, it's good, but it's not fantastic. However, I think with the multi-channel and the online, if that continues to gain traction, I think you could do very well at a P of 17. So I like it. I like the valuation, and I think the valuation is pretty fair, actually. John, what are your thoughts on Dunelm as a company and these results?
I mean, I thought they were, like you say, excellent results. I guess it's coming into that valuation probably similar to Next, and they're not dissimilar companies. Would you choose Dunelm over Next?
I'd probably be picking Next. I think Next is just slightly more impressive, and the figures are just that little bit better. But I'd say that's probably more of an argument that Next is maybe trading at a lower valuation than it possibly should, rather than Dunelm is overvalued. Interestingly as well, I forgot to mention the dividend yields 2.7%, so it does have a decent dividend as well. So
no, I think, well, with Next and Dunelm, like them both as companies, and these are possibly some of those relatively attractive looking companies that don't have eye-watering valuations that are in. Is it FTSE 250 or?
It is, yeah. It's only 2.6 billion market cap.
Okay. but that are knocking around in the FTSE 250.
It's interesting because we've got as well on the FTSE 100 and the FTSE 3 and the FTSE 250. There's some very, I know like there's some very, very bad retailers, but there's also some very, very good ones. Like Dunelm and Next are quite good examples, but there's a few of them where you look at it and they have actually transitioned to online very, very well. And they've not just hold their own, but they've probably strengthened as a result.
Yeah, no, I would agree. It's not like an HMV.
That's definitely not like an HMV, or even like when we looked at Curry's. I mean, that's more. I mean, that was There's just nothing particularly inspiring about that. I didn't think.
Yeah, no. These home stores seem to be a bit better from that point of view.
Yeah,
maybe it's
I think
sort of seeing it, holding it, touching it.
Yeah, I think they benefit a lot more from the multi-channel. It seems because it is sort of similar types of business. Because you've also got other ones where there's some very, very good retailers as well in the UK, but they don't have the online presence. So like your Primarks and your B&Ms. I mean, they're pretty good businesses, but they're not. It's not online that's driving those businesses.
Yeah, but they know what they do well.
Yeah,
and they have. Yeah. Fine. Okay. So next company is Unilever.
a company that maybe doesn't know what it does well.
Well, yeah, in recent years, I think that's definitely been true. This is one of the FTSE 100 largest companies with a market cap of about 98 billion. They had their full year results out this week with underlying sales growing 4.5% to 52.4 billion euros, which was actually ahead of analysts' expectations. And that was as a result of higher prices and a slightly small, a definite smaller increase in volumes. Underlying operating profits rose 29% to 9.6 billion euros. However, they caution that they expect cost inflation to be very high, which could amount to as much as 3.5 billion euros in material, freight, and packaging costs. If we break those results down a little bit further, the beauty and personal care division with brands like Dove and Vaseline saw underlying sales growth of 3.8%, with 3% coming from higher prices. Underlying operating profit was up from 4.6 billion euros to 4.7 billion euros. In the home care division, underlying sales growth rose 3.9%. However, input costs meant that operating profit actually fell from 1.5 billion euros to 1.4 billion euros. The food and refreshment division performed more strongly, with Ben & Jerry's and Magnum of the brands in that leading underlying sales growth of 5.6%, with volumes and prices both rising, leading underlying operating profit to rise 6.8% to 3.5 billion euros. There was growth across all regions, but Europe was the slowest. As a business overall, the higher capital expenditure reduced the cash flow to 6.4 billion euros compared with 7.7 billion euros a year earlier. The group announced a further 3 billion euro share buyback alongside a quarterly dividend of 42 cents a share. In terms of valuation, Unilever has a market cap of around 98 billion pounds and trades at just under 17 times forward earnings compared with a historical average of 19, and it's currently yielding just under 4%. I'm a long-standing shareholder of Unilever and I really like its brands, but I do feel it's slightly lost its way, as you alluded to and as Terry Smith recently highlighted. I would like them to rejuvenate some of the brands, innovate more, and only make very select acquisitions that can really have the top quality brands, as opposed to those that were in the proposed Glaxo deal, that will be able to maintain their margins and lead sales growth in a similar way to as Diageo had been doing in recent years, rather than buying back its own shares. I'm not particularly optimistic for the coming year, and I think the cost pressures will no doubt eat into their already declining margins. So I think that is of concern. But I think ultimately the quality of the business, whether it's with the current chief executive or the next chief executive, will shine through. But it's not the most exciting business, and the short-term outlook, I don't think, is good for Unilever at the moment. But I'll be holding my shares. Sam, what do you think?
Similar to you. I think the operating margins coming under pressure is very concerning. I think one of the best things about Unilever is, it's got some it's got some wonderful brands actually. And that reflects in some very wonderful operating margins as well for the industries in which it operates. Unilever's, got much more of an emerging markets focus than some of its peers. So that means I think it's probably going to have possibly slightly less ability to pass on all those costs to customers when the increases are that high, because they were talking about when they're only got underlying operating profit of 9.6 billion, and they're saying that they could have cost inflation of 3.5 billion. That is a huge proportion. And it's not like, when we're talking about, if the price of a pack of Pringles goes up by 10p because you've got 4 or 5% inflation that you need to pass on, I think that's fine. People are going to pay that. But if you're talking about more like 20-30%, at that point people start thinking, well, do I want the Pringles or the next best thing? So they possibly won't be able to pass all that on. So that's concerning. We've talked about the management before, because we did cover, however many weeks ago it was certainly in the last couple of months, the proposed Glaxo deal, which we didn't like, and fortunately hasn't gone through because it was rejected. But that's probably only because the shareholder backlash was so strong. And for them to then come out and, when they said, because they said they'd received a strong message from shareholders about the need for portfolios. And it's like, again, like, why are the shareholders making decisions instead of management? Like, that's basically, I don't think the shareholders trust the management, and I don't think they should. And as well, like, why is the debt going up and they're doing buybacks?
Yeah.
Are they, and especially like we could be in an environment now where debt's not quite as cheap as it maybe has been in the past.
Yeah.
We don't know. I don't know whether that's going to happen or not, or interest rate, but it's more of a possibility than it was 6 months ago. I do think it's a business that's lost its way. I think it is a very, very good business, though. Like you said, whether it's under the current or the next chief executive, I would probably expect it to be under the next chief executive. I wonder when the AGM is actually, because I'd be surprised if some decent sized shareholder doesn't put in a motion to get rid of the CEO. And if I was a shareholder, I would be voting for it. I do love the business, but not the management.
Yeah. Okay.
A lot to unpack there.
Yeah. No, I'm just having a look.
It's like a roast, wasn't it?
It's usually in May, but I don't think there's a date for 2022.
You could put forward a motion, couldn't you? Are you allowed?
I could do. I'm not. I wouldn't say.
You could go and speak at the meeting.
I might turn up actually. I think it'd be quite, and then I can report back to the podcast.
Yeah.
The new chief executive.
I mean, it's probably going to be the most interesting Unilever AGM they've had in some years, I'd imagine.
Yeah. Exactly. No, we'll watch this space. Okay.
What do you think of the buyback then? Just out of interest.
I'm not keen. I'm definitely not keen. And I think they announced 3 billion, and it's another 3 billion over the next year, I think. So that's 6 billion. But no, I'd rather it be reinvested into the business rather than just buying back their own shares, and either rejuvenating, or if it were a smart acquisition, a bit like Diageo when they bought some sort of exclusive tequila brands, if it were more like that, then I'd be in favor of it. But yeah, I think they need to work on that, on the, I suppose, some of the fundamental aspects of the business, rather than, like you say, not really respond to, having the tail wagging the dog with the shareholders and the management, which is what's been happening recently, as we saw after the backlash from the Glaxo takeover, or attempted takeover. Fine. Okay. Barratt Developments.
Yeah, the first of the two house builders we've got this week. So Barratt Developments have come out with their half-year results. They've reported an 11.1% fall in completions to 8,067 as demand patterns normalised following last year's lockdowns. Lower completions, build cost inflation and other costs meant underlying operating profit fell 55.3 million to 449.9 million. The group now expects to complete 18,000 to 18,250 homes this year, 250 ahead of previous guidance and ahead of pre-pandemic levels. An interim dividend of 11.2p was announced, up 49.3% on last year. Barratt said it would be introducing a phased reduction in ordinary dividend cover, with cover of 2.25x in 2022, reducing to 1.5x in 2024. Shares were unmoved following the announcement. Revenue fell almost 10% to 2.2 billion, which reflected reduced completion volumes, which offset a 4.5% grand increase in the average selling price per home to 288,000. Private average selling prices rose 2.5% to 327,400, while there was an 8.1% rise for affordable homes to 157,100. The average sales rate per outlet per week was 0.79 compared to 0.77 last year and 0.69 in 2020. 22% of private reservations used Help to Buy, down from 49% last year. Barratt operated from an average of 337 outlets, down from 342 last year. Total forward sales were up 9.1% as at the end of December to 14,818 homes, valued at 3.8 billion. Build cost inflation was around 5% in the half, and this is expected to increase to around 6% for the full year, although the effect on margins is expected to be minimal. I would be surprised if they can't continue to pass on any build cost inflation via an increase in the prices, just because we build less homes than we need every year. The group approved 673.4 million of operational land for purchase, which equates to 8,869 plots, and that 673 million compares to 254 million last year and 406 million the year before. They've invested around 410 million on land acquisitions and the settlement of land creditors during the year. Expect to spend around 300 million more on land this year compared to 2021. Lower profits meant Barratt had free cash flow of 29.4 million, down from 788 million last year. Net cash was 1.1 billion at the end of December, which was in line of last year. Interestingly, their expected exceptional costs of 40 million this year, and there was 81.5 million of exceptional costs in 2021. And this has happened for a few years now, where there are exceptional costs every year, where they're spending money on rectifying previous issues. And if you're getting them year after year, at some point you have to question whether the costs are exceptional and should be adjusted out. In terms of the valuation, they are currently trading at a price to earnings ratio of 10 and have a prospective dividend yield over the next 12 months of 6.6%. They also have a return on capital employed of 26.8%, which is very high. These were decent results, although the fall in completions was slightly concerning, given, without giving too much away, that wasn't experienced by the next house builder we're going to look at. But I thought they were decent results, and I think it's a very fair valuation if the housing market doesn't dry up, which I don't know. I struggle. I guess a lot of it does come down to as well what happens with interest rates, which seem to be on the up. My view is it's always dangerous putting something like this out there on the internet forever. I don't see them going back to significant levels. I think when you look, like when you look at 20 years ago when we were at like 6-7% interest rate, I just don't see that. I think the government debt is too large that it just becomes unserviceable at a certain point. So I think the Bank of England can only raise interest rates so much. I think if the stock market has a fit when they try and raise them too much, they then bring them back down pretty quickly. There's lots of other issues politically, which I don't think the market's particularly like at the minute. And again, that's probably a reason why you'd be maybe less inclined to raise interest rates. I appreciate that if you've got inflation going up and up, you need to do something. But I think they've almost, because they've kept them so low for so long, I do feel like they're almost fighting inflation now with one hand tied behind their back. So I could be very, very wrong, but I struggle to see a scenario where interest rates go up significantly over the next few years. And I think based on that, if you think that won't happen, I think a P of 10 and a yield of 6.6% is very, very fair. John, what are your thoughts on these results and the valuation for Barratt?
I would tend to agree with you. I will go on. I'll go through the Redrow results, and then we can sort of talk.
Yeah, I think that makes sense,
because otherwise we might be repeating because it does apply to both of the businesses. So Redrow, which is one of Britain's smaller of the large house builders, had their half-year results also out last week. With house price inflation continuing to exceed build cost inflation, first half revenues were up 1% to just over £1 billion, 1,052 million to be precise, and ahead of pre-pandemic levels. Operating margin came in at 19.5%, which is 2.4 percentage points higher than last year. Profit before tax came in at £203 million, which represents a 17% rise on the previous year. And the order book grew to £1.5 billion from £1.3 billion a year earlier. However, legal completions were down 10%, similarly to 2,749. The group made further progress in the land market with 3,316 plots added to the current land and 2,945 to the forward land. All divisions achieved a 5-star customer recommend score, and the group have said that there's been a strong start to the second half with a value of private reservations per outlet per week for the 5 weeks to the 6th of February, averaging £417,000 in total and £367,000 excluding a bulk deal in London, compared with £301,000 in 2021. And they've upgraded their guidance for 2024 with revenue expected to grow between £2.3 to £2.4 billion and operating margin increasing to between 19.5% and 20%, and return on capital employed of between 22 and 25%. In terms of valuation, Redrow has a market capitalisation of around £2.2 billion and trades at just 8 times earnings, with a prospective dividend yield of 4%, but it is rising. And I think the interim dividend they're paying is up from 6p to 10p this year. The other thing to mention is that its cladding provision has been recently increased to £36 million. But if you compare it with some of the other builders, Redrow has generally built more sort of detached family homes rather than blocks of flats. So it's a bit more sheltered from what might happen in the cladding saga. So yes, like you were saying, Sam, I mean, I think there's the structural imbalance. There's a great demand and not much supply when it comes to houses. And the government wants a home owning democracy. So I think with the builders as a whole, they're all set to continue to gain from it. Who knows what will happen with interest rates, but it doesn't look like you say that they would go prohibitively high. But, you know, it's very difficult to make those, I suppose, those macro forecasts.
Which would you have the better results?
I mean, it's got a slightly higher return on capital employed at Barratt, but I think probably overall Redrow did, and Redrow's slightly cheaper as well.
I'd agree. I mean, the Redrow revenue, it wasn't up spectacularly, but it was up, whereas Barratt fell, didn't it? So I don't really know what the actual reason is. I had a quick look on. My first thought was, could it be like exposure to different parts of the UK and like exposure to London? I had a quick look on like Google Maps to see the number of outlets, and Barratt does seem to have like a higher proportion in the London area, but I don't actually know what the reason is. It might just be that Redrow have performed better. I don't know, but it's just. I mean, the Barratt results were fine, and I think the valuation's fine. What's the Redrow valuation like?
In terms of price to earnings?
Yeah.
It's 9. Sorry, 8. 8.
Yeah, I'd rather pay 8 for Redrow than 10 for Barratt, I think, especially when Redrow's got the better results.
Yeah, no. Well, I'm a Redrow shareholder and very happy to hold it. Would you buy one? Would you add it to the watch list?
I do like them. I don't see myself buying any in the near future, probably because of more opportunity cost than anything else. It's similar to the reason I got rid of Ibstock. It was a perfectly fine business, but it's a bit, I don't know, it's a bit too steady for me. I like something that can drop 80%. You don't really have that with these. But
well, I mean,
they
did drop a lot in sort of March, April 2020. So you were probably cut in half at that point, but saying that, most things were cut in half at that point.
Yeah, they're back to basically where they are now. But I don't know. I think if I was to get a house builder, it'd probably be a Redrow or Taylor Wimpey, or maybe just a basket for the two. Yeah.
And would you be reinvesting your dividends, holding your dividends?
I'd be much more inclined to reinvest the dividend in a house builder, I think. I think there's a lot of long-term tailwinds, whereas the tobacco industry doesn't really have that. It's interesting. It's interesting as well that for Barratt, I thought the fact that the proportion of Help to Buy sales had dropped by so much.
Yeah.
I thought that was quite interesting. It's probably obviously it's a good thing the less dependent they are on Help to Buy.
Exactly, healthier for the business. Yeah. Fine. American company of the week, Disney.
Yeah, Disney, favorite of the show. The House of Mouse. So I won't bother introducing the business if you don't know what Disney is.
Switch off now.
Yeah, I don't know how that's possible actually, but I think I reckon Mickey Mouse. I'm sure Mickey Mouse, for children in the US, he's more recognizable than the president of the US. I'm sure that's true. Yeah. Although I guess that's true for a lot of things. I think it's true for Ronald McDonald as well. But anyway, so they've come out with their Q1 results, and revenue rose 34% to 21.8 billion in the first quarter, and all these figures are in dollars, which was better than analyst expectations. There was growth in both media and parks, with the most dramatic increase coming from Disney Parks, experiences and products. Group operating profit more than doubled to 3.3 billion, which was also better than expected. Total group profit was boosted by the non-repeat of 113 million of restructuring and impairment charges this time last year. The shares rose 7.7% in pre-market trading following the release. If we break them down by division, media and entertainment division saw Disney Plus subscribers rise 37% to 129.8 million, while ESPN Plus and Hulu also posted growth. It's interesting as well because in the last quarter when we covered the Disney Plus subscribers, they did have a little wobble and the shares didn't react very well to it. And seeing as we beat ourselves up for Shell every few months for what we said about that at the bottom, we did say when it had that little wobble that we weren't concerned and we thought it was just that. So I just thought we'd highlight that success there. The average monthly revenue per paid subscriber for Disney Plus Hotstar increased from 98 cents to $1.03 due to launches in new territories with higher average prices. Despite this, higher production, marketing and technology costs meant operating losses for direct-to-consumer products rose 27% to around 600 million. There were also higher programming and production costs in the traditional cable business, meaning operating profit also fell. For the media and entertainment division as a whole, operating profit fell 44% to 808 million. Parks, experiences and products saw revenue climb from 3.6 billion to 7.3 billion as travel trends, park footfall and cruise ship sales improved. However, Disney also said it's continuing to limit capacity for safety reasons. The division saw operating profit swing from a $119 million loss to a profit of 2.5 billion. The group said increased operating income at our international parks and resorts was due to growth at Disneyland Paris and the Hong Kong Disneyland Resort. Free cash outflows widened by 505 million, reflecting higher payments due, other obligations and spending for TV content, and net debt stands at 39.7 billion. In terms of the valuation, there's a prospective dividend yield over the next 12 months of 0.5%, and the business trades at a forward PE of 32.2 compared to a 10-year average of 22.4. However, those are still on somewhat depressed earnings. My view is I think this is a very good quarter. I think the Disney Plus is excellent. I don't think the fact that it's operating a loss makes no difference to me whatsoever. I think when you look at an average monthly revenue per paid subscriber of just over $1, they've got a long way to increase that. They're at 130 million, and I think they were targeting something like 240 million by either 2024 or 2025. I think they're going to hit that, and I think they're going to slowly, year on year, they're going to increase the price of the subscription by probably quite a bit above inflation. And I think you will just see that start to feed into the operating profits more and more. So I think, and as well, I think for the parks has done fantastically, especially considering we're still not back to normal for that kind of business. So I think a PE of 32, it's still, to me, it's still priced as if Disney Plus is not going to be a significant contributor in the future. And I do think it will. If I was a Disney shareholder, which I no longer am, because I decided to sell it to top up Pinterest, which so far has proven to be a poor decision. But if I was still a shareholder, I would be delighted with these results. And I think the Disney Plus numbers are very, very impressive. John, as a Disney shareholder, what are your thoughts on the results and the valuation?
Well, yeah, I mean, I think, like you say, it's sort of on somewhat depressed earnings, but incredibly high quality business. It's got some of the most valuable intellectual property you can imagine. And you've got Disney Plus, which is growing the subscribers, and it's got a huge amount of scope to increase its revenue from that through price rises. And it's pretty cheap at the moment. So I'm very happy holding it, and it's one of those businesses that I would hope to. Well, I don't even need to think about it. I can sleep easily at night, and I'm very bullish on it going forward. So a happy Disney shareholder and impressive results.
Yeah, it's back to being my favorite business that I don't own.
Yeah,
so I expect I'll have to rectify that at some point again.
I suppose again, I'd be bullish on COVID subsiding and the parks getting back into the full swing of things, and the continued growth of Disney Plus. So I think with all of that together,
one thing I was thinking as well, average monthly revenue per paid subscriber of $1.03 is so low. I mean, even here in the UK, I think I got the email through the other day saying it was going up to 80 quid for the year or something. I mean, that's still, what's that, like, I don't know, like £7 a month or something. So like, I mean, it must be so cheap in some countries. I guess they must have a lot of people who've given it to for like a 1 year free one or something. Yeah. But I mean, that is incredibly cheap. I think in fact, I'll find out what the Netflix one is actually. That'll be an interesting comparison. So this is Q4 2021 for Netflix, and this is per region. It's $14.78 in the US, Q4 2021. Wow. It's $11.64 in Europe, Middle East, and Africa, $9.26 in Asia Pacific, and $8.14 in Latin America per month per user. And Disney average for the whole, including the US and all the other developed countries, is just over $1. I mean, in 10 years' time, that could be as high as like $10, and then you don't need to worry about that loss they've got from it then, because the content spend won't have gone up by that much. It's just, and that's as well, like, they're still, what is it? They're at like 130 and they want to get to 240. I mean, you add another 90 million users on as well. It's ridiculous how profitable it could be, I think. So, which I don't think is, baked into the share price as much as it should be. I don't think it is either. So of the 6 businesses we've talked about today, British American Tobacco, Dunelm, Unilever, Barratt Developments, Redrow, and Disney, if you had to buy one, if you had to pick one, which one would it be? And same question with Disney excluded.
Okay. Yeah, I think you predicted it there. I would have gone for Disney for the reasons that we've just discussed. In terms of the British companies, probably go for Redrow. Really strong tailwinds behind the business, and it's not expensive. So I think probably price to earnings of 8 with an optimist. I'm be optimistic about the future. I'd definitely go with that.
I'd also be Disney as my first choice. If I couldn't have Disney, it'd probably be British American, actually. Okay. Ethics aside, I do like it, actually. British American would probably be mine. So we've got different ones this week.
It's not too boring.
Yeah, well, we did both pick Disney technically, but
yeah.
But who wouldn't?
Yeah, who wouldn't? Fine. Well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.